Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by David Broomfield. I very nearly said Happy New Year, David. Hello, David. How are you?
Well, you can't say Happy New Year. There are rules against these things, Sarah.
There are.
Well, I was told, and maybe a listener can write in and correct me whether it's apocrypha or not, that it's apparently a very British thing, that saying Happy New Year long after the New Year.
Oh, really? Oh, okay. I know in German, when I lived in Germany, you wished people at midnight, Guten Rutsch, which is like a good slide into the new year. But you say that just around midnight. Not
or someone can write in and correct us both, I'm sure.
Yeah, exactly. All right, then. Now, we are going to, there's only one topic. Well, there's actually a few topics we could be talking about, but we are going to be focusing on bonds this week, bond markets. I'm going to resist the temptation to do a kind of very bad Sean Connery impersonation.
I got you there. A bit slow, but I got you.
Thank you. But before we get to that, quick fire numbers round. I've got a cracker this week. Well, I think it's a cracker. Maybe I should not raise expectations. Do you want to go first?
Yeah, it's like saying Sarah's got a really funny joke. Everyone gather round. No, I'll go first. So my numbers, I'm going to round it. Forgive me. My number's around 10%. Now, 10%, incredibly, was the contribution to S&P 500 returns from one stock. Care to guess what that stock was? It was the stock of 2024.
Well, it's got to be NVIDIA, hasn't it?
It was NVIDIA, indeed. So
10%.
10% of S&P 500 returns from that one stock alone. So I put an absolutely killer chart from Alpine Macro on LinkedIn that shows that, just to give everyone a view of just how pivotal tech is still in the market and how it's very much the narrative there.
Even though we discussed at some point last year, I can't remember when it was, we did talk about the broadening out from the Magnificent Seven. It was still 10% of returns last year.
Yeah, rates of change and just sheer weight, I suppose, are just two different things. I mean, it's just enormous. Yeah. Okay. What's your number?
My number is 1.3 million.
1.3 million. No idea.
Or depending on the currency, 207 million.
Oh, you're giving me hints. Or 207 million. Okay.
Yeah. I'm not going to tell you what the currency is because that might be a giveaway.
Yeah, go on then. I think I might know the currency. Go on. You tell me the stat.
It's the price paid for a £608 bluefin tuna at Tokyo's prestigious New Year auction.
Yeah, exactly. I identified the currency. I should have went with my intuition. Very good.
Second highest price ever paid. The highest price was 333.6 million yen. Amazing. Have you visited Tokyo Fish Market? I have, yeah.
It's an incredible experience.
It's a great place. And of course, the New Year tuna auction is very, very important because apparently it brings good fortune as well as bragging rights for the successful restaurant, whoever buys that first tuna of the new year.
Exactly. It's incredible art. Some of the dealers, they can just by feeling the fish, and obviously these things go to auction and they have very little idea what the full cross section is like, but they can just tell. It's like an intuition.
Yeah. It's like a sort of, it's an art. It's definitely an art, I think. Anyway, so that moving on from tuna and NVIDIA, bond markets. Now we're not going to get into the politics of what might be happening in various different countries. We're going to talk about, well, I don't know, what are we going to talk about? What's happening?
Well, we've had so much drama in bonds. Even when we recorded the pod last week, it was going on. It's been going on since about September last year, but it's reached a kind of crescendo in the last couple of days. And in fact, today, with a slightly softer inflation print, some of the fear and steam has come out of this high yields narrative. But let's talk about bond yields, because there have been significant rises in them since mid-September last year. And we'll talk about what's going on and why it's happening. And you're going to have to indulge me and forgive me. We're going to talk a little bit about some different components of bond yields. And it's really important because we're going to then talk about, in our second topic, something called term premia.
Yes, which is a term I've heard bandied around quite a lot and I think needs explaining.
So we'll talk about term premia, and then let's talk about what this means for markets, what this means for bond markets and equity markets, as much as we know with our crystal ball. And why don't we talk a little bit about the possible policy pathways that we might find ourselves in?
Okay, well, let's kick off then with what's happening. I mean, other than the obvious that yields are rising.
Yeah, okay. So yields are rising, significant rises in bond yields since mid-September. So, the benchmark that we use there is the 10-year US Treasury, which has increased by over 1%. or around 1%, probably now since mid-September. So you're around 4.65% for US Treasuries, and for a 10-year gilt around 4.75, around about there. A similar, Treasuries and gilts have been moving in lockstep since the sort of trust mini budget, and there are reasons for that, which I won't go into. And that increase has basically been happening. Those increases in yields have basically been happening at the kind of 5 to 30-year end of the curve. Okay, so it's not the short end of the curve; it's sort of longer end of the curve across both UK and US markets. That increase basically is markets anticipating higher interest rates over the medium to long term. So history tells you, if you go back and look at bond yields, that it's quite unusual for yields to rise once you enter a rate cutting cycle. And we entered a rate cutting cycle. Yeah. So to see yields rise is very unusual. Why are they rising? Well, they've had this big revision, and this is where the tension is, I suppose, highest in the market about how many rate cuts we're going to get. So you've gone from September last year saying you're probably going to get about 5 rate cuts in the US to now more like 1 to 2.
Yeah.
Right. And even if you go into the options market, and I said this last week on the pod, if you look at the implied probability of interest rate hikes, at the limit, there's a probability of around 40%, 30 to 40%. So, you can see that the market at that end of the yield curve is very concerned about rate cuts. Now, so how do we refer to that? We refer to that as the yield curve steepening, those that remember those sort of economics textbooks. But it's not all about inflation, right? Okay. Inflation expectations have actually been pretty stable, right? And we can measure that. We use inflation break-evens. So remember, when I have talked about bond yields before, we remember our simple identities, okay? The nominal rate is basically, or the nominal yield is the real yield. So that's the nominal yield minus inflation, right. Plus the break-even rate. Okay, that's the spread between inflation-linked bonds and non-inflation-linked bonds, right? Yeah. So that's how you sort of decompose nominal yields into these two components, real yields and break-evens, right? So you can then see which of those two components is moving. And what you see actually is it's not the inflation expectations, that's the break-evens that are moving, it's the real yield component is moving. So, why is that? Yeah. Now, you can actually go further, and this is why I said I warned you guys up front, you're going to have to indulge me. If you take the real rate or the real yield and break it down further, you can do the identity another way. You can say that the real yield is actually the expected real yield or real rate plus this thing called term premia or the term premium. And the term premium is really important. We'll come back to that in a moment. Yeah,
that's our second point, isn't it?
Because this is what all the economists out there are disagreeing what's driving sort of long-term yields up. But a lot of it is actually attributed to term premia. So we'll come into term premia in a bit. It's basically fiscal policy, bond issue. There's lots of things that can go into that category.
But essentially then, are we saying that the market is recognizing that essentially the economy is much more robust than perhaps we thought it might be as we went into a rate cutting cycle? The consumer is remarkably resilient. The labour market is remarkably resilient. And so the expectation is that inflation is not going to come down as quickly, perhaps, or that last bit's going to be extra sticky. And so we're not going to get those rate cuts. So is it actually a positive thing?
Yes, in theory. But term premiums, when we talk about it in some detail, we'll get into this. But it could be all of those things. But it could be looser, I'm hastened to say, sort of reckless fiscal policy. It could be issues with the structure of the bond market, bond issuance in the wrong place. It could be even a policy mistake. So to your point, things are running too hot. And, rising yields. So why? Okay, so David, the yield curve steepened, the yield's gone up. So why? Why is this important? Well, higher yields raise borrowing costs for governments. Really simple as that. Makes it more expensive to finance debt. And, we know our inverse relationship because we've been through that before. The value of existing bonds decreases as yields rise. Okay, so newer bonds offer higher returns. And when you're in this rising rate, when you have that rising rate environment at that end of the curve, you basically have an effect on growth momentum, and you cool down growth. Okay, and you saw a little bit of that late last year. In fact, actually, it's probably reversed again more recently. And in fact, it looks like it might even be slightly hotter than we thought, and that's what's driven a lot of this. But rates that are rising like that have a dampening effect on growth, and that's what the market's been worried about.
And there are, and behind that, there are concerns that, I saw a figure that net government debt in the US is expected to exceed 100% this year. And yearly deficits are set to exceed 7% of GDP in the US this year. So that's behind that, isn't it? We're worried about, or investors are worried about, the amount of debt that governments are running up and their deficits.
It is. It's the bond vigilantes out there. But I would again just caution here, particularly those sort of fiscal. I'm not a deficit hawk. I think it's all about sustainability of debt. And if you look at debt as a percentage of GDP, and you look at those debt payments as a percentage of GDP, you can see actually they're reasonably okay. Yes, they're going up, and as more debt sort of matures and has to be reissued and rolls over, then the burden of that goes up further and further. But compare it to the early 90s, late 80s, it's lower today than it was then in terms of the burden on the economy. Because remember, it's as a function of GDP. Because yes, your debt's gone up, but your GDP's gone up. Okay, so and this goes, but this is why the market is so concerned about the nature of borrowing. If you're borrowing for investment leads to GDP growth, then the debt is serviceable. If you're borrowing just for expenditure with no discernible impact on GDP, then you have the problem, and that's what the bond vigilantes would punish. So at the moment, I'm not a deficit hawk. I think though, I think it's all about sustainability. It's still sustainable.
Yeah. Okay.
Remember, I love the quote. So you'll have to let me. It's the Maynard Keynes quote that remember about debt, we owe it to ourselves.
Yes, that's true.
And when we come to, and why is that's not just a pithy quote, it's relevant to the policy that manages debt. Remember, it's not just rates. You've got sort of balance sheet operations, QT, QE. You've got other mechanisms that allow you, when you issue your own debt in your own currency, as the US does, you have a myriad of different tools in order to be able to manage it.
Okay. Well, then this you use this expression term premium or term premia. What is that? What does it mean? And why is it perhaps a cause for concern at the moment?
Yeah, okay. And thank you for bringing me back on topic. Term premia is basically the extra yield that investors demand for holding long-term bonds instead of short-term bonds. Okay, so it compensates the bondholder for the risks like of inflation, economic change, central bank policy shifts. Sort of, it's quite an important part of the when you decompose nominal yields.
Okay, so I guess in simple terms, then, the risk if you're holding a 10-year bond that rates may change is greater than if you're holding 2 5-year bonds back to back.
Yeah, exactly. And you can measure it sort of, relative to. I mean, think about it like this. Think about it if you're lending money to a friend over 1 week or over 10 years. What are the odds that something unforeseen happens over 10 years with that individual? That individual
fairly high.
Exactly that. Well, I won't speak for your company, but your friend could do anything with that money over 10 years. Over 1 week, it's less likely. Yeah. And that's perhaps a somewhat a crude explanation, but you can understand term premia if you look at interest rate swaps for equivalent maturities. Okay, so an interest rate swap is where you exchange fixed interest payments for floating interest payments. Okay, so it's basically your benchmark for financing costs without direct exposure to government debt. So when government bond yields rise more than swap rates, bonds are said to have cheapened relative to swaps, and that indicates higher term premium. So we might have to pause and rewind and listen to that. But that's there are ways you can measure it. So when that spread widens, what it suggests is that investors require greater compensation for holding government bonds over swaps. Okay. So why do they require more compensation? Because that reflects increased perception of risks or maybe supply concerns. Remember my structural point about the bond market. And some of that will be, we said we wouldn't talk about politics. We're not going to talk about politics, but some of that will be just an uncertainty factor about we're not quite sure what the policy mix is next year and what effect that might have. Now,
you use the word perception there. That suggests to me this is not a objective calculation. This is subjective term premium.
Well, it's quantifiable, measurable. Okay. But you're right that the bond market, it's always the equity market that's dismissed as the emotional melange of different, animal sentiment. But the bond market is much more technocratic and much more easy to decompose. It's a very mature, unemotional discounting machine. But when you look at what's going on in bond markets right now, and the bond vigilantes, as we talk about, there definitely is tension in the bond market. But some of that will be structural, right? Because there have been big changes to the structure, and we won't necessarily get into it on this podcast on what debt has been issued over recent years at what part of the yield curve. Janet Yellen in particular changed how the US Treasury issued debt quite considerably. And so I think there is some tension there. So it is, I have to say it is objective, not subjective, because it's the bond market. Okay. But my intuition is there is some subjectivity in it, particularly when it comes to how focused the market is getting on inflation prints and non-farm payrolls. It does feel a little bit subjective.
So if the risk premium is going up, does that mean that we're going to get higher yields? Is it that direct relationship between the two?
With term premiums going up, you mean?
Sorry, yes, term premium. Thank you.
It's risen. It basically affects that longer end of the curve. Okay, and you've seen that in lots of global markets, right? It's not just a US thing. You've seen it in the UK as well. Yeah. And there's lots of drivers. So you've got the structural point: central banks reducing bond holdings by QT. That's been going on. You've got the deficit hawkish point, the increased government bond issuance, it boosts supply and pressures yields higher. And then the risks point, this sort of this may be the more subjective point of the three, which is about the economic and inflation outlook as well. And simply put, high term premium makes it more expensive. It increases the borrowing costs. Okay, and you can do a number of things as a central bank to try and lower short-term rates to offset long-term borrowing costs. There's a scenario known as fiscal dominance, but I won't go into that again, but it blurs the line a lot between monetary and fiscal policy. As we record this today, a lot of this tension has come out of the market with a slightly softer inflation print. So it feels like yields are settling, obviously, structurally much higher than what they have been for the last 10 years. And we went through this last week. Inflation is sticky on the way down, but tensions are high. There's a lot riding on a smooth disinflationary pathway and rate cuts.
And I think we can expect ongoing volatility in bond markets, can't we? Because there'll always be something that's going to set people off and get concerns about what's happening with borrowing and deficits or inflation or...
Yeah, perhaps. But I agree. But I think I said last week in the 2025 outlook, the bonds are looking quite attractive potentially. And that's if we get a more benign economic outcome than the market's pricing in.
Okay. Which then, if let's say the yield on the 10-year stays relatively high, I don't know if you said before, in the US, what is it now? 4.7, something like that?
Yeah, below 4.65.
Okay. What does that do if it stays persistently high and close to 5%? What impact does that have on other asset classes? Do suddenly people think, do you know what? I'm going to buy some government bonds. I'm not going to put money into equities. I think that's a pretty good return.
Well, that's so you've got the 10-year see there, and you've seen it further out on the curve as well. It does, in the US market, you see it most acutely in the housing starts numbers, okay, where you have the housing market effectively stalled or broken because people are unwilling to, as first-time buyers, and in America, in contrast to the UK, you have very long-term borrowing when it comes to property purchasing. 30-year mortgages are not uncommon at all. And the price of those has obviously gone up massively as that long end of the curve has gone up. So there are actual implications for it. And I think the effects there are definitely, there's definitely an investor sentiment effect as well. You can see you can see investors looking now at bonds as high yielding instruments, like or up the credit spectrum, potentially in the short term, being more attractive than equities. I mean, I think the earnings story is still incredibly strong in the US, and over time, equity risk premia will ultimately deliver more for you than what you would get but you're compensating more as an equity investor through risk premia than what you would be as a bond investor. But yeah, you can see potential investments diverted away.
I suppose arguably, once yields on, say, the 10-year get to 5%, then that will become irresistible and people will pile into bonds and then the price will go up again.
Yeah. I mean, the principal impact of these high yields, I think, is the discount rate that's used in future cash flows. If you're looking at future corporate earnings, if you're trying to value a company or value a stock, you're using some of these numbers as discount factors. So you reduce valuations as a consequence. And notwithstanding the actual impact on the bottom line, where you have corporate borrowing costs going up, you're squeezing margins, things like that. You're deterring businesses from expanding. So there are structural effects on the market from investors and also at company level as well. I think also the thing that's often not talked about is the international implications. So, the US yield has a pull to other global bond yields. Okay, it puts a lot of pressure on international markets. Emerging markets can drive, that point you just made on diverting capital. You can, by having US bond yields up or rising, you can see capital outflows, particularly from emerging markets, and then causing their currencies to weaken, potentially financial instability. Now, I'm not saying that's the situation today, but if you go back in time and look at periods of history where the US yields have spiked, you can see that. And then you're in a tricky situation if you've got a dollar pegged currency, because you might end up having to raise your own domestic interest rate if you've got tightening domestic financial conditions. So there is an international element to this. This doesn't just all happen in a vacuum in the US, in the UK. There are cross-border capital flows that get quite considerable impacts from this kind of thing.
And how does this impact then central bank policy and what happens with interest rates, mortgage rates, deposit rates, borrowing rates? How does this then filter through into those sort of elements?
Yeah, well, the situation as we record this has actually got a bit better over the last sort of 24 hours with the inflation print coming in softer. So people are now saying, okay, perhaps there is now more support for rate cuts this year than we thought. But how would you deal with it as a policymaker, and would you want to? You could, of course, cut short-term rates, but then you're easing financial conditions, right? You're tipping more fuel onto the inflation fire. And particularly if real yields are high because of inflation expectations. Now they're not currently. Inflation expectations are pretty anchored, but it would be risky just cutting short-term rates because term premia has gone up. I mean, that's not what a policymaker would do. QE, of course, is the potential way of bringing down that long-term yield. Central banks could start buying long-term bonds, and they inject liquidity into the market. That has different set of consequences. Again, that can have an inflationary effect. And there's an inequality effect of what that does generally to other asset classes as well. You can adjust, obviously, QT on the other side of it. And then in other countries, not particularly in the US, you've got yield curve control as well. There are ways you can directly intervene. I don't think we're there yet. It's not, this is more, I think, the stickiness of inflation and the uncertainty factor of the policy mix this year. These are just sources of volatility and uncertainty, and the macro would imply that there's no need to intervene at this stage.
Okay. So in short, what we've seen with rising yields is down to, as you said, stickiness of inflation. There's a degree of uncertainty. At the time of recording, we're going to have a new president next week, and there's lots of question marks about what he might be doing and what policies he might introduce. But it's not necessarily anything we should be concerned about at the moment, with the caveat that obviously things can change.
Yeah, I think it just shows you how high the stakes are for growth, right? Because you want growth to come through justify the bond market stance. Now, if growth doesn't come through this year, then yeah, you've got some big volatility, I think, in bond markets. So yes, you're right. It's kind of, is it a good problem to have? Which was, I think, your original question.
Yeah.
Does this just reflect a very positive backdrop? Yeah, that is part of it. But I think we can just expect volatility over the coming weeks and months in the bond market. But remember, you would expect that this disinflationary, I talked about it a lot last week, there are sticky components, and one of the stickiest components has been the services sector print.
Yeah.
And that has shown now some positive signs. And by positive, I mean it's coming down.
Yeah.
But it's going to be a bumpy pathway down. And we're going to settle when we get to sort of, terminal rate, we're going to settle at a much higher rate than what we have been in that period post-financial crisis up to 2022. And that's important because at those higher rates, bonds need other assets in portfolios to help the portfolio with its diversification. And we talked a little bit about that before.
Yeah. So forget about zero interest rates.
Yeah, I think so. I think that continual disinflation, deflation. I think given frictions in global trade, given the geopolitical backdrop, I think that's a pipe dream going back to zero interest rates.
Okay. All right. On that note, a reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you, David. Thank you for listening. Until next time on Need to Know, bye for now.